Intel stock just had a terrible day. Not only was the stock down 5.5% on the day, but after releasing their Q2 earnings report, the stock went down an additional 18.9% after hours. That is horrible. And this earnings season, Intel may be in the lead with the worst report so far. That new stock price of $23 will be the worst that Intel has seen since 2013. It is even going below the fall 2022 price. So what happened? Intel announced a surprise loss on earnings far below expectations. On top of that, they gave guidance for an even worse third quarter. But it didn't stop there. Intel announced it will be suspending its quarterly dividend payments starting in the fourth quarter of 2024. This followed the 65% dividend cut in 2023. However, the company has announced a cost-cutting program in hopes of turning around recent performance. That includes a reduction of 15,000 employees, which we'll see in the headlines. In today's video, I'm going to provide an updated stock analysis on Intel, break down their Q2 earnings report, and explain whether I think it's finally a buy or whether you should continue staying away from Intel stock. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Now, some of you longtime viewers know that Intel was one of my worst investments ever. I started analyzing the company and buying in early 2022 prior to the decline of their business and massive capex spend. My thesis was that the company would provide reliable cash flows while expanding into a manufacturing business through their foundry model. At the time, the company had a history of sustainable dividend growth. However, all of this proved to be false in the following year, and I ended up selling during the fall of 2022. I ended up putting all of that money into Microsoft stock, and I have a total return of 74% since then. And I learned a very valuable lesson during this time of investing in Intel stock. First off, semiconductor manufacturing is extremely expensive. You have to continually invest into cutting-edge fabrication plants, and they don't actually have the longest life cycles. And if you ever fall behind in process technology, then that comes back to bite you. Also, Intel's number one business, the client computing group, which is CPUs for PCs, is not a growth business. It is entirely dependent on the number of PCs and laptops being sold every year, and it is facing significant competition from the likes of AMD, ARM, and companies like Apple, which are now designing their own chips and getting them manufactured by third parties like TSMC. This is all at the expense of Intel, which sucks since CPUs is not a high growth market overall. After the stay-at-home boom of new PCs, Intel's cash from operations fell apart. It went from a peak of $35 billion down to $11 billion in 2023. This is while they grew capex from $14.5 billion all the way up to $25 billion for 2023. This sent free cash flow to negative $14.28 billion. That is horrific. And when you have deeply negative free cash flow, you can't afford to pay dividends or buy back shares. Both of these trends stopped at the company. On top of this, they started to lever up with debt to pay for this manufacturing investment. And yes, you can make the argument that Intel needs to make these investments to stay relevant as a business long term, and I would actually argue that's true. But that's part of the problem over the next few years as an investor. Semiconductor manufacturing is so expensive. And from this lesson, I actually switched to investing in fabless semiconductor companies like Broadcom. Their capital expenditures are far less, and the company is a free cash flow machine. By outsourcing the cost of building these fabrication plants to a third party and only focusing on design, you have a fundamentally better business model. It is far more capital efficient. And in early 2023, I bought Broadcom stock, selling at nearly a 200% total return this June. And that's a pretty fantastic return in a little over a year. But this video is really about Intel. So I'm going to break down their Q2 earnings report and see if there's any positives that could make Intel be a buying opportunity right now. On top of that, I'll discuss the details around their dividend cut and their Q3 outlook. By the way, if you want to use the stock research tool I'm showing throughout, then please sign up at dividenddata.com. I built this tool to help you make better investing decisions, and it more than pays for itself. It definitely helped me identify these problems around Intel. Okay, so second quarter revenue came in at $12.8 billion, down 1% year over year. Second quarter GAAP EPS was negative 38 cents, which is terrible. Non-GAAP EPS attributable to Intel was 2 cents per share. In the third quarter 2024, they are forecasting revenue of $12.5 billion to $13.5 billion. This is down from Q3 2023 of $14.16 billion. They are also expecting third quarter GAAP EPS of negative 24 cents per share, and they're expecting non-GAAP EPS of negative 3 cents per share. So even worse from a non-GAAP EPS standpoint. They're also implementing cost reductions and reducing reducing headcount by 15%, and adding to that, they are suspending their dividend payments starting in the fourth quarter of 2024. So if you own Intel stock, you're still getting your next dividend payment in the next couple months, but then the fourth quarter dividend has been suspended. However, the company reiterates its long-term commitment to a competitive dividend as cash flows improve to sustainably higher levels. Now, we've seen this in other companies that have reduced their dividend, whether it was Disney or AT&T. So the bottom line here is that this may take far longer than you think for the dividend to come back. And when it comes back, it may be far smaller than you think. So I would not be investing in Intel stock from the dividend perspective. However, it still could be a long-term value play at these lower prices. And if we look at Intel's business segments here, you can see that Client Computing Group is their largest, which is their CPUs for PCs. That's $7.4 billion for the quarter, which is actually up 9% year over year. However, we have to put into the context that their Q2 2023 was horrible, so it's coming from a very low base. Also, their data center and AI business was $3 billion in revenue, down 3% year over year. Q2 2023 was weak in that as well, and they renamed this to include AI, even though they are losing significantly in AI. They're capturing virtually none of the massive data center spend going on right now. All of that is going to companies like NVIDIA, which are focused specifically on the AI use case. Intel barely offers any products related to that. Their server infrastructure is more traditional and kind of CPU focused. It does not utilize any of the advancements among parallel computing related to GPUs. Revenue for network and edge came in at $1.3 billion, down 1% year over year. But if you're investing in Intel stock for the long term, it's all about this Intel Foundry business. That came in at $4.3 billion, up 4% year over year. And this is where they're building manufacturing capacity to sell to third-party chip designers. In the rest of Intel's business, they design and manufacture the chips. However, they are hard at work trying to open up their manufacturing capacity to third parties and follow a TSMC-like business model, which can work. It's still very capital intensive, but if you hit proper scale, then you could build a pretty wide economic moat in that business. However, that is still many, many years away from being a profit driver for the company. And in terms of profits, operating income for Client Computing Group was $2.5 billion for the quarter. That was up a sizable amount from Q2 2023. Operating income for data center was $0.3 billion, which is down year over year. And operating income for edge was $0.1 billion and flat year over year. And while the foundry business saw 4% year over year revenue growth, their losses expanded significantly with negative $2.8 billion in losses that quarter. This is horrific. However, to give them credit, they are nowhere near this being a profit driver for the company, and they are still in the capital investment and build out phase for much of these manufacturing facilities. And this is not getting better anytime soon. For Q3, they're projecting revenue down, gross margin down, and EPS down. The only thing positive for Intel is that their free cash flow is becoming positive, and that is only due to contributions and incentives received through government programs, which is amounting to $5.9 billion in Q2. In reality, though, Intel's spending is out of control relative to their operating cash flow. The company has no ability to return capital to shareholders anytime soon. However, Intel is not going to die as a company. They have a strong balance sheet and plenty of resources to pivot and eventually become far more profitable than they are today. They're reducing operating expenses, reducing capital expenditures, and reducing their cost of sales to help improve profitability. However, that will likely not see any impact until we move into fiscal 2025. Over a 5-year time horizon, the Intel Foundry business will likely grow significantly from all these capital investments they're making today in increased manufacturing capacity. On top of that, their core business segments, while they may not be high growth businesses, likely can be run in a profitable fashion and provide cash flows to the company. So it's possible that if we look at a very long-term time horizon, then Intel stock may be a good value play. However, there are a lot of negative catalysts that will still be existing over the next few quarters. And prior to this earnings report, the consensus price target among analysts was $40.88, which implies significant upside from here. However, I would not be surprised if that price target declines significantly following these results. I would also not be surprised if you see far more sell and strong sell ratings from analysts. So thank you for watching this video, and please subscribe for future stock analysis content. Sign up for dividenddata.com so you can use my stock research tool and look at my portfolio live to see what I'm buying, and sign up for our email newsletter to get this content directly in your inbox, plus some additional content that doesn't make it into the videos. So with that said, thanks for watching.